Welcome investors. And in last 8 months, we have gone through a decent correction. And these are the times when, you get some bargain on the table, and these are the best time to do the research. And that is what I'm doing right now. And there are a lot of good ideas coming. And I have tried to identify five ideas where I am currently working on. Some of them I'm invested, some of them I'm still exploring. So nothing is a stock advice, but I thought I will share some of the ideas which I am currently working on with little bit of research because the work is still going on. So the first idea which is there, it is based on the theme of financialization of savings. And if you remember 3, 4 years back, this theme was very, very popular. But the typical names which came were the companies from asset management industry, platform companies. Some of them did create wealth, but they have undergone decent correction. So why I'm interested in this idea is because this particular company, it is trying to, it is beating actually the number one, number two companies in terms of growth, and they're doing few right things. So because of that, I'm interested, and I will go through each of these ideas in more detail. The second idea, it's a FMCG and QSR proxy play. And this company, it is more a B2B company, but it is also trying to transform into a B2C company. So this is where, it excites me to convert from, if there is a possibility to convert from a B2B to B2C, that is one. Second, it's a FMCG play, which is, more industry with good financial economics. And third, it's a QSR play, which is again a high growing segment. And we had done a webinar on QSR 2, 3 months back. In case you have not seen that webinar, the link is there in the description. The third idea is a capex based operating leverage chemical company idea. So I have not discussed much about chemical companies on my YouTube because my chemical sector exposure has been limited, but this is one company which I have been tracking from last 3, 4 years. I was invested, the stock did well, and again it has corrected, and I feel the kind of, the history it has and the kind of future growth prospects it has and the kind of valuation it has, this could be a good time to visit. And I took a position 2 weeks back recently. The fourth idea is again a capex based idea, which is again an operating leverage play. And this is in the auto sector. And I think I have been talking about auto sector on different platforms. On YouTube, we did a auto sector YouTube live. I did blogging on auto sector. I have been talking on Twitter. So obviously, I am invested in this, and this still looks interesting given, the auto sector is moving. I think there is a lot where this stock can do the catch up. And the last idea is more of a cyclic idea where, there is a mispriced valuation. But this company looks though very small in size, but all the numbers which I look, it looks much better than peers in an industry which is cyclic. So we'll go through that. So let's look at it, each of these ideas separately. The first idea from financialization of saving theme is Nippon AMC, which is the asset management company of Nippon. Earlier, it was, the Reliance business, but Nippon from Japan, they purchased this business. And these are some of the mutual funds. We invest in bank Bs or index funds. So there are a lot of popular Nippon funds. Now, why I like this business, the business is, it is one of the largest, asset management companies in India with almost 7.2829% market share, and present in mutual funds, AIFs, and various investing and wealth management businesses. In terms of financials, so one thing you'll find, all these five ideas which I am exploring, each of these ideas will have average to good to very good to excellent kind of financials. And when I talk of financials, it could be balance sheet, it could be cash flows, it could be growth, it could be return on capital. So key 4, 5 things which make a company good in terms of balance sheet, cash flow, PNL, and growth. Most of these companies will have fair to sound financials. That is one. And the second is, most of these companies are at a juncture where valuation, if not super attractive, it might look fair to attractive. And again, 3, 4 years back, financialization of saving was in vogue. Everybody was willing to pay any price, which was there in the market. And of course, that doesn't make money. And that is why I have seen, even the HDFCs of the world falling 50% almost from the top price. So now I believe in last 2 3 years, the asset management industry has not made any money. So maybe it's a good time to study. And that is why I'm exploring this idea. Now, why I'm interested, of course, this industry has a lot of tailwinds. The whole concept of financialization of saving, if we look at the mutual fund penetration in India, if you look at the equity culture in India, there is long way to go. And this company is growing much better than the industry growth rate. And I like what they're doing on the product innovation side in terms of launching products, which could be the future in terms of ETFs, index funds, and some of these innovative products. I will not talk much about the risk because all these work is still in progress. My suggestion would be, if you have not explored, maybe you can explore and research it further and see if, some of them, they look interesting to you. In terms of valuation, so this company is available at 4% plus dividend yield. The PE valuation is around 25x. But I believe given the kind of growth it has, and these kind of businesses, they don't need capital to run. So whatever money they earn, most of the money, 70-80% of the profit will get converted into free cash flow, which will be distributed in the form of dividend. So that is how we should look at the valuation. The other thing is we are doing a detailed webinar on AMC industry. The details are there to participate in the webinar in your description box. So please register in case you are interested. And we are going to cover the whole industry in deep, the historical analysis, the nuances, the future. We are going to study some 4 or 5 good AMC companies. We are also going to study companies which are proxy to AMC companies. We'll try to see which businesses are better. So that is the webinar update. Let's come to the second company. So the second company is into FMCG sector. It is one of the recently listed IPOs, got listed, I think 1 year back, Bector Foods. So it's a leading B2B player in biscuits and bread segment. It has been a B2B company, but they have some B2C brands, some private labels. The B2C brand is more on the bread side, bun side. So this company, though it's a good B2B company, it is trying to make inroads into B2C, and if they can scale their B2C, nothing greater than that. Also, it's a North India. It has been a North India focused company, especially present in Punjab, Jammu and Kashmir, Delhi, those kind of areas. But they have also started expanding in Western and Southern India. So they have set up a plant in Maharashtra. They are trying to increase their distribution in Maharashtra and in Karnataka. And again, if we look at financials, again, the company has reasonable growth. They have grown at almost 9-10% sales, which is the typical FMCG growth rate. But the PAT growth rate and cash flows has been much better in terms of 16 to 20% growth rate. And the company has decent return on capital, 14%. It's relatively lower to typical FMCG company because it's a B2B company. But if the B2C business picks up and they're able to scale up their personal brands, the ROCE can increase further. There is a decent cash flow conversion happening, and the company has reasonable debt to equity ratio. Now, why interested? So one, it's a play on the FMCG sector, which is kind of more evergreen sector. It's also a play on the QSR sector because the QSR sector is growing at 15-20%, and this company is one of the biggest suppliers in India for QSR chains for breads and buns. And then there is a B2C opportunity involved. So the best part is when we get into businesses where there is something to look at, either in terms of a higher margin business or a better quality business or a better operating leverage play, along with good financial economics, along with decent valuation. These are the situations where the chances of making money becomes higher. And maybe if one of them turn winner, that takes the whole portfolio in a different zone. So in terms of valuation, this company is available at 20 times cash flow, 15 times EV/EBITDA. These are not very high valuation for a FMCG company, though it's a B2B company. The fortunes remain same like how it will be for a typical FMCG company. And if the B2C business becomes bigger, then sure, there could be possibilities of re-rating apart from all the growth which is there. The third company is a small chemical company called Ultramarine Pigments. It's a Chennai-based company which is there into pigments and surfactants. And this company has a typical characteristics of consistent compounders when we look at last 3, 5, 8, 10-year history. And the only thing I would suggest is to never look at only 1 year data, because 1 year could be outlier, and what kind of supply chain disruptions have happened in last 1 year, and the kind of raw material price shoot up has happened. So of course, when you look at last 1 year data, it may not look so interesting, but when you look at 3, 5, 8, 10 years of data, especially 5 or 10 years of data, you will see that the company has maintained decent growth. The top line has grown at 14 to 17%. The PAT growth has been around 12 to 19%. The cash flows has grown at around 12 to 20%, depending on what set of 3 or 5 or 8 year horizon you take. Also, the return on capital has been decent, 16 to 20% return on capital. Uh, Cash flow wise, it's not great, but they have been able to convert 60% of their EBITDA into cash flow, and it's a debt-free company. It has remained a debt-free company. Few things. So try to study about the difference between what is the pigment, where it is used, like it is used in paints and all. Then try to learn about surfactants. The other thing is they have a small IT business. They are not scaling it up, but it's like a cash flow business which is generating cash flow for them, and they're just going ahead with it. Now I'm interested because there are companies which keep delivering on a consistent basis, and sometimes it may look like they're lagging by 1 or 2 years, and then again they come up with a new capex and again they grow. So something similar which is happening here, and it's a silent compounder with clean management. They have been executing well, regularly coming with capex. And again, there is a proposed capex. Right now, the company has gone through a margin compression because of all the supply chain disruptions, and I believe it is below its normalized margin. So the impact of capex which will come live, in fact, the capex which came live some time back, and the possibilities of operating leverage, all that makes this company interesting. The other thing which is interesting is I think this company trades at a market cap of 950 crore, and this company is related to Tirumalai Chemicals. So Tirumalai Chemicals holds stake in this company, and this company holds some stake in Tirumalai Chemicals. And if we take current valuation of Tirumalai Chemicals and give some kind of holding discount, remove it, I see this company should get X Tirumalai stake. That valuation. This company is available at around 600 crore valuation. And as per my estimate, if we take the new capex into consideration, currently itself the company generates somewhere around 50 crore. If we take the new capex and all, it may do 75-80 crores of kind of peak profit. So peak profit post the equity holding, ex equity holding, this comes around almost 7-8 times kind of valuation, which I feel is attractive. So that's the rationale for this particular company. The next company is from auto sector, India Nippon Electric, and I have been tracking this company for last 1 year. When I started looking at auto sector, keeping an eye, and this is the auto ancillary company from the TVS group. TVS is again one of the most reputed groups in South India, and this company is present in ancillary business in two-wheelers, three-wheelers, mainly two-wheeler, where TVS and Hero, they are two biggest clients, and they're present both in ICE and EV. They used to be more ICE based player, more in ignition system kind of ancillaries. And as slowly the IC business may get disrupted, they have tried to enter into EV business. They're having a EV portfolio. They have recently set up a full-fledged R&D center. Also, they have tie up with another company called Mahle Electric Japan, through which they're getting the technical know-how. Also, we need to see how TVS Group is doing in terms of electric business, or being a TVS Group company, they will get that kind of advantage. And why I'm interested, because I track TVS also. I'm invested in TVS, and I believe TVS is doing really well. So this company should get benefited. Again, coming to the financial economics, the same kind of financial economics, a debt-free company. There's a decent ROC. The growth rate has been slow, but what has happened? This company took 7 years to double its net fixed asset between 2012 to 2019. But of late, there have been some management aggression, and in last 3 years, the capex has doubled. So what took 7 years to double, this time it has happened in 3 years, in the worst of auto cycle. And this capex, which has gone from 60 crore to 130 crore of net fixed asset, this is yet to contribute on the revenue side. Now, again, this is interesting because actually I have a position, I started building positions at a lower level, though I still find it attractive, but the kind of valuation I was looking around 850 crore at 370 rupees. The company has almost 300 crore of cash on books. So if we remove the cash on books, basically we are left with 550 crore. And at the peak of auto cycle, this company did almost 55 crore of profit. Now, with the doubling of capex, this company in next peak cycle, and given auto is slowly picking up, they can do 90 to 100 crore of profit. That is my estimate. So basically, we are paying again 550 crore of uh, 550 crore of valuation for almost 90 to 100 crore of profit, which is like a 5x 6x valuation. So that is how I see this company, very attractive. Again, we need to research more. We need to understand the risks. How much is the risk because of IC? How much is the opportunity in EV? The other thing is the management has identified certain specific business segments, and aftermarkets and exports are two business segments they have identified to grow. And the company has done really well where they are growing at 49 to 56% in these markets. In auto cycle, the company has performed much better than the two-wheeler segment. So because they're primarily a two-wheeler ancillary player. And if we look at the growth, because basically two-wheeler has gone through a degrowth where this company has been able to maintain its performance. So it has done better than industry, and it has gained the wallet share for its clients. So it looks pretty interesting given the kind of valuations, the business, and what they're doing on the EV side. They're coming with a lot of products in the EV side. They have set up a R&D center, just for the EV opportunities. So quite interesting to look at. So again, I have spoken about auto through, one webinar, one YouTube live, through blogs, through, Twitter messages. But again, we have been studying this industry for last, 1 month, and we have done some detailed study, which is still going on. So again, we plan to have a webinar on the auto as well as electric vehicle sector, where we plan to cover the whole industry in detail with the whole EV landscape for two-wheeler, for four-wheeler. We are going to study some very interesting 10-15 companies, not only from short term, but also from long term. So the details again of this webinar is available in the description box. Do check if you're interested. The last company in the list is NCL Industries. It's a small cement company from South India, and it's a AP and Telangana based company from the Nagarjuna group. 85% of the revenue comes from cement, but they have some other businesses also like cement bonded particle board, where they're the only player I think in India they do it. Then they have doors business, a bit of hydro energy business, but bulk of the business is cement business. What I like is, though it's a small company, of financial economics is very, very good. And actually, let me highlight, this company went through CDR in 2014 to 16, because the whole Andhra belt went through a huge political crisis in 2012-15, and there was a lot of oversupply in the cement industry, and the infra's demand went through a big halt. And that is where the company went through its bit of issues, but finally it came out of CDR in 2016, and since last 6 years it has done really well. So I'm showing more of that last 6 years of performance, and they have done well in terms of 13 to 18% top line growth on a multi-year CAGR basis. Profitability growth has been decent, everything in double digit. The ROCE has been decent, above 17%. Now there is no balance sheet risk. It is available at reasonable debt equity of 0.4. The cash flow conversion is also decent at around 70%. So I find the financials much better than peers. Last 5-6 months, cement sector has gone through decent amount of correction. The entry of Adani has further taken the prices down. So there is a cyclic pessimism. There is a industry pessimism because of big player entry. And actually the promoter is buying from the open market, and this company is available at 5 times EV EBITDA. The other way to value, if you look at it, this company is available at around 750 crore of market cap, and they have net fixed asset of 770 crore, and almost 170 crore of capex is work in progress. So it looks quite interesting and cheaper. Even if I try to do the valuation analysis. And one of the analysis which we did a detailed webinar on valuation again and again, you can check in the description box. So one way to do valuation is we look at the historical 10, 15, 20 years of the historical valuation means, and we see what is the current valuation standard deviation, and if it's lower from the mean, and if the financials have improved, then it's a good sign. So the way we see it, the company may not be as cheap as 2014 valuation, but that was the time when the company went into CDR. But the valuation is slowly coming closer to that, which is, always a good sign, because we are getting things cheap at, 5 EV EBITDA with very good financial economics. So that is why I'm interested in this particular company. So this was regarding these 5 companies. Let me know if you want to cover one of, if let's say we have to cover one of these companies in detail. Let me know which will be this company, and we cover a lot of such companies in much more detail. We have a annual membership program where we cover lots and lots of such studies in detail, where already all of our previous work, some 30, 40 hours of research content with 4, 5 sector analysis, some 15, 20 company analysis, market analysis, and a lot of things are available. Also, a lot of these webinars which we are going to conduct, like on auto sector, on AMC sector, there are a few more webinars coming. So if you're a part of membership program, all of those webinars, all these detailed company analysis, everything comes as a part of that package. So again, the description for the annual membership plan is also there in the description box. If you plan to take it, then don't register for any of the webinars. That will also already be included as a part of this pack. So I hope this session was useful, and let me know which is the one company out of these 5 you would like me to cover in detail, and I will cover in detail sometime. Thank you.